You've probably seen the headlines: RBI injects 1.9 trillion rupees into the economy. Sounds massive, right?
It is. But what does it actually mean for us? For the economy? Today, we are cutting through the jargon to break it down.
Let's start with what the RBI is doing. Two key tools: Open Market Operations or OMOs and a dollar-rupee swap.
With OMOs, the RBI buys government bonds around 1 trillion rupee worth from banks. In return, banks get cash.
Which means more liquidity in the banking system, more cash to lend. The bond buys happened on 12th March and 18th, by the way.
The second move is the USD INR swap, $10 billion worth, with a 3-year timeline. Essentially, RBI gives banks rupees now in exchange for dollars, and they reverse the deal in 2028.
So again, more rupees in the system right now, while also managing forex reserves long term.
Now the why. Early March showed a serious liquidity crunch. Banks were short over 20,000 crore rupees.
Part of that seasonal, companies pay advance taxes in March, which pulls money out of the system. RBI is just smoothing the ride.
Stable banks mean stable markets, and that fuels economic growth. So what's the impact?
For starters, banks can lend more. So if you're eyeing a home loan or if a company needs capital to grow, this move helps.
We've already seen some market reaction. Banking and PSU stocks ticked up after the announcement.
Plus, with the RBI's small rate cut back in February, borrowing costs could ease further.
And that currency swap. It also helps keep the rupee stable, critical for importers, exporters, and anyone managing international exposure.
So to recap, more money in the system, lower stress on banks, and potentially more accessible loans for you and me.
It's a big move, and it'll be interesting to watch how it plays out in the months ahead.
Thanks for tuning in. We'll keep tracking what this means for the market and for your money.